I'm Yahoo Finance Executive Editor Brian Saz, and you're watching a live shot of the opening bells on Wall Street on this post-holiday Tuesday morning, and you're not seeing things. Bed Bath & Beyond and its outspoken Executive Chair Marcos Lemonis ringing the bell at the New York Stock Exchange as it tries to convince everyone it's still relevant, and BMW Group getting things underway over at the NASDAQ. Summer may unofficially be over, but there are a few fireworks still poised to pop off on Wall Street over the next few weeks, and they are wasting no time lighting up markets the day after the Labor Day holiday. Federal Appeals Court ruled Friday against the Trump administration's tariffs, but it left them in place until October 14th, allowing the White House time to appeal the case to the Supreme Court. All right, let's head over to Yahoo Finance senior reporter Brooke DePalma, who is standing by at the NASDAQ in Times Square. Brooke, lots going on here on this Tuesday morning.
There absolutely is lots going on here as we make our way into September. Of course, today to September 2nd, the first official day of trading for this month, which is typically a very volatile month. We know that the S&P 500 has averaged about a 4.2% drop in the month of September, and we're slowly making way into this month, seeing a similar return so far. Intraday trading, we're seeing the S&P 500 down about 1.3% as we kick off this week and today's trading session. The NASDAQ leading the downward momentum, that index falling about 1.7%, and the Dow down about 1%, largely playing into this narrative that September tends to be extremely volatile. I do want to point out one stock that I am watching, and that's PepsiCo. We know that Elliott Management has taken a $4 billion stake in the food and beverage giant, and that's causing stocks, this PepsiCo stock, to jump. It's up about 5.5% as we make our way into the open. They're calling on largely what could be a very rare and historic opportunity for this company to turn things around. And also, we continue to see mega breakups in big food. Let's take a look at that. We're seeing Kraft Heinz that announced today that they do and plan to split up. And we're seeing just a bit of movement there when it comes to Kraft Heinz, under just a bit of pressure, down about 0.5%, and they're splitting up into two companies officially: Global Taste Elevation Co. with those big names like Heinz, Philadelphia, Kraft Mac and Cheese. That will be one, and North America Grocery Co. will be the other, behind Oscar Mayer, Kraft Singles, and Lunchable. We know that this company has been under pressure, down nearly 9.5% year to date. And just taking a look off of the back of that, we do know that KDP, ticker, of course, KDP, that's Keurig Dr. Pepper, they also announced a major breakup for that company as well. They're going to be Global Coffee Co. and Beverage Co., which will include those energy drinks. As soon as that was announced, we saw the stock sell off, and now it's down nearly 17% in the last 10 days alone. But taking a step back to kick off this new month, we are seeing all three major indices in the red, and the NASDAQ leading that downward momentum there, down about 1.8%. Back to you, Brian.
Yeah, Brooke, I just got off the phone with Kraft Heinz CEO Carlos Abrams-Rivera. I asked him why he's even doing this deal. He said, we just thought we were undervalued. We'll have more on this deal coming up. Thanks so much, Brooke. Appreciate it. All right, here's what I'm watching as we settle into the trading day. Challenging the Trump tariff, a federal appeals court has ruled that President Trump went too far when he declared national emergencies to justify global tariffs. While the administration will have until October 14th to challenge the ruling, the reality is that this decision has cast a new cloud over corporate America and markets. How the uncertainty is priced into stocks is now very much in focus. Positioning for an easier Federal Reserve and perhaps a less independent Fed. Gold prices have broken out to a fresh record high above $3,500 an ounce. The price of the yellow metal has now doubled since the start of 2023. The latest push higher reflects investors bracing for a steady drumbeat of rate cuts from the Fed, which historically is bullish for gold. But investors are also growing concerned with President Trump's challenges on the Fed. Any weakening in the Fed's independence is viewed as bullish for gold. And lastly, when the CEO misbehaves, the 2025 string of misbehaving CEOs getting shown the door rages on. Nestlé over the weekend booted its CEO over an inappropriate relationship with a subordinate. And the CEO of alcohol giant Suntory Takayama reportedly resigned today as his home was searched for illegal supplements. These come on top of the viral kiss cam debacle for now former Astronomer CEO Andy Byron, and the resignation in March of Kroger CEO Rodney McMullen for an undisclosed incident. Lots going on here on this Tuesday morning after the holiday. Opening bid on the roundtable today, that is Victoria Fernandez, Crossmark Global Investments Chief Market Strategist, and Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. Victoria, I'm going to come out with you right out of the block here. These Trump tariffs, big news that hit, I believe, late on Friday, and a lot of focus in markets here on them this morning. What if tariffs completely go away? How undervalued is this market, if it's undervalued at all?
Well, I think if tariffs completely go away, we've got a lot of issues we have to deal with. Not only, is there a question of do we have to do refunds for money that's already been brought into the country? What does that mean for deals of countries and companies that have said they will invest here in America? Does that all go away? I think we'll see the longer end of the yield curve move significantly higher because a lot of this tariff money, this tariff revenue was supposed to help bring down the deficit or at least cover part of the cost of the reconciliation bill, the one big beautiful bill that was passed. So if all of that goes away, I think you've got a lot of uncertainty in this market. You've got higher yields. You've got concerns around what it means from a macro viewpoint, but yet you probably have companies say, well, wait a minute, now prices can come back down, maybe margins won't be compressed as much. So I think there'll be a little bit of a give and take, but the uncertainty around it will definitely cause some chaos in the markets.
Well, Victoria, let me follow up with you on this one. If tariffs go away come October, that potentially pulls off the potential for a rate cut or a series of cuts, no?
Well, it could pull it off, or the Fed could look at everything and say, wait a minute, now do we head into a recession from the sense that the uncertainty in the markets causes consumers to pull back? Does it cause people to stop spending? Then maybe you continue to have that slowdown, and it could give a little bit of support to keep that. But probably they would look and say, all right, we knew it was going to be a one-time lift to inflation, at least according to what Powell has said. That comes off the table. Maybe there won't be margin pressure. There won't be layoffs. That's going to help the labor market. So odds are you probably would have odds of a rate cut really diminish.
And as I remember covering when gold broke $2,000 an ounce, and that was a big thing. Now it's at $3,500. What's the market read through from that?
Yeah, it just keeps going higher. I mean, it's the safe haven trade. It's yields going lower, the anticipation of yields going lower. It's the fact that you have other central banks buying gold, perhaps instead of U.S. Treasuries. There's a lot of elements that have been pushing gold higher. For right now, it seems to continue to have a tailwind on it. But things could change pretty quickly if some of these other elements we were talking about actually come to pass.
Inez, let me get over to you here on the roundtable. I know you closely study gold. To Victoria's point, I mean, it's hard to see where the top is in gold prices here, Inez.
Yeah, and Wall Street is still very bullish on gold going into 2026. As she was mentioning central bank, as Victoria was mentioning, central bank demand. That is a structural change that has been going on since 2022, which was what Wall Street has been pointing to. And that does not seem to be changing anytime soon. So despite the fact you had a consolidation period, now it seems to be that there's a breakout, in part because of course, the Fed expecting that the Fed will be easing. And this tends to be bullish for gold. But also you have expectations of inflation. You have geopolitical issues. You have over the weekend that picture of China and also Russia as well as and India, the leaders from those countries. I mean, all of this is sort of bullish when it comes to gold prices. And by the way, it's not just gold that has been surging. You also are seeing silver that has gone above $40 per ounce. And that is also just bullish for the precious metals in general.
Victoria, back to you. What's the play on gold? Do I go to Costco, pick up gold bars? I know Brooke, who follows retail, would love for me to actually go do that and put a post out there on X about it. Is it a gold ETF? Is it a gold stock? How do you play it?
Yeah, I think you've got a few ways to play it. We would probably look at doing something around a gold ETF, or even you could look at some of the miners. They had, been performing a little bit weaker than what you'd seen in the gold ETF. So perhaps that might be a place you could step in and add a little bit. So I would play it that way more than buying physical gold, just because that's, we're in the markets and that's the way we like to play things. And it gives you a little bit more flexibility if you want to change your position pretty quickly.
Brooke, at the top of the show, you were talking about some of these big food breakups, and I look at this move in gold. Maybe I'm trying to read too much into it, but anyway, I look at this move in gold, and it says a lot about where inflation could go over the next 12 to 24 months, likely perhaps even higher. And I just think a lot of these big food companies are realizing inflation is here to stay, and they're just not going to earn some of the margins they used to on some of these old brands like a Lunchables.
Yeah, I certainly think there's a few ways to look at this. We have Campbell's earnings call this week, and we'll certainly wait to hear more about what exactly they say about aluminum and the impact that tariffs has had on that. But also, it's really this twofold here, where the pressure on the consumer, but also the pressure on the companies trying to mitigate the impact of these tariffs on their margins, and that's largely what's been called out. Is really this, especially the North America businesses, especially around PepsiCo, this weakness that we've seen in volume growth over the past few years, really since a peak in 2022, post-COVID, as consumers were still at home. Now, as we made way into this year, with so much uncertainty, with so much hope heading into the year that consumers would return to discretionary, we continue to see this ongoing weakness when it comes to volume growth for not only Kraft Heinz, of course, they're announced a mega breakup today, but also the reason why you have Elliott Investment Management pumping money into PepsiCo, looking to get more of a hand in that turnaround story. And also, we just had Keurig Dr. Pepper announce their major breakup. And of course, Keurig Dr. Pepper, one of those companies that they're going to split into, is a coffee company. And that just goes to show that there is major focus needed in order to mitigate these tariffs, mitigate those weather patterns that are impacting cocoa and coffee futures as well. And right now, under one big umbrella, it just does not seem to be working. We know, we've heard from so many sources that those core portfolios are being reevaluated, and it looks like breakups are in right now when it comes to big food.
Yeah, speaking of breakups, that's a nice segue, Brooke, from where I was going next. I mean, this is the year of the CEO big breakup. I mean, we have Nestlé CEO getting ousted for inappropriate relationships. Suntory CEO reportedly bought illegal supplements in Japan. His house was raided or checked. Kroger CEO Roddy McMullen resigned in March. Of course, you had the Kiss Cam debacle. You had Ashley Buchanan over at Kohl's. Victoria, when a CEO resigns for whatever reason, what should an investor do? Because they're not used to seeing situations like this. Or maybe they should be.
Correct. Yeah, and a lot of it is company specific, right? And why the CEO is stepping down. But I think this puts a big focus, Brian, on the governance component of companies when you're looking at what companies you want to invest in. What does that look like? What does the board look like? What do the potential replacements for the CEO, what is their experience? What does that look like? Because it could be like any of these that you've mentioned, where all of a sudden the CEO is out, and then you question who is leading this company and who is running it. So I think it puts a very special light on maybe starting to look at some of these other elements when you're going to invest in corporations. But I don't think you can just say across the board, oh, it's a new CEO, you need to sell. That's not necessarily the case. Sometimes the person coming in, there's a lot of excitement around that. We've seen it at Chipotle. We've seen it at Starbucks, right? When CEO changes have led to some excitement. So I think it's a case-by-case basis.
Answer of the morning, Victoria. 5 stars for you. And Nez, last word to you here. It's not good when a CEO gets kicked out for any of these reasons. And Victoria brings up a good point. It really makes you have to study a company's board. It's just not a bunch of faces on a website.
Exactly. And especially in this era now that we have, where a CEO is sort of a celebrity, so to speak, when it comes to their how they speak, how they come across. And in the age of social media, that's also a magnifying glass. So any mishap, there is just no room for it. I mean, you are dealing with an economy and a situation where everything is so sort of precarious, where margins are thin when it comes to food companies, for example, where you have higher input costs, higher labor costs, and so you just can't have these types of distractions coming from your top leadership.
All right, my roundtable is cooking with gas, and they're going to hang out with me for a little bit longer. Straight ahead, media mogul John Malone tells me he's open to a sale of Formula One, and we take a look at whether a broken-up Kraft Heinz is worth your investment dollars. We'll be right back. Welcome back to Opening Bid. Somewhat under the radar, Apple stock is rallying into the expected September 9th unveiling of the latest iPhone. Shares are up about 10% in the past month alone. A new note from Citi analyst Atif Malik may explain some of the bullishness. Malik says he is expecting a strong replacement cycle for the upcoming iPhone, given the age of the installed base of iPhones currently out there. Malik found that almost 50% of iPhone users are on the iPhone 14 or earlier models. These phones even work? I don't even know. Consumers will need a new iPhone to take advantage of the many AI features Apple is working on, Malik notes. All right, let's fire up my stock of the day for today. Media mogul and Liberty Media chair John Malone still sees more upside in Formula One after 10 years of ownership. The position isn't hard to argue. Liberty Media introduced Formula One racing to a U.S.-based audience through races held in Miami and Las Vegas, and it branched it out to living rooms and smart devices courtesy of F1 TV and direct-to-consumer streaming options. The Netflix series Drive to Survive also cemented its cult popularity on this side of the Atlantic. Apple's mega hit F1 movie this year starring Brad Pitt only added to the sport's allure. Here's what Malone told me about the future of F1 in a new Opening Bid Unfiltered podcast drop.
Look, it's a public company. If somebody gets carried away and they want to buy it and they're willing to pay more for it than the board thinks that they can deliver to the shareholders, then we would sell it. I mean, that's the bottom line. Mm-hmm. But right now, it's gangbusters, and it's got essentially a reconstituted dream team for me.
All right, still with me, my opening bid roundtable, Victoria Fernandez, Brooke De Palma, and Inez Ferre. Victoria, let me get over to you. The media landscape has been a disaster. Warner Brothers splitting up, Comcast splitting up, but here's Liberty Media, Victoria, that has a prized asset in Formula One, and now it might near a new streaming deal, perhaps. Some of the rumors have been with Apple. I mean, what a brand.
Yeah, look, F1 is just gaining popularity everywhere. I actually saw the movie on Friday. Fantastic movie. So I would tell anyone to go see it. Yeah, it is. But you look at the demographic for F1 and it is growing. So I have a college-age daughter. She and her roommates all watch F1. There was the Netflix series about the F1 drivers. So there's all these elements that have really brought a lot of people in. The Dutch Grand Prix was yesterday or Sunday. I watched that when I was at home. So there's a lot of elements to F1, movies, Netflix, watching the races, going to the races now that you have some here in the U.S. that I think are really strong tailwinds for F1, and I think it's just going to continue to grow. So it should be a star for Liberty Media going forward.
All right, I'm writing this down in real time, Victoria. How do you play this? Do you play the F1 popularity through Netflix? Of course, they're still streaming Drive to Survive. Is it Liberty Media that owns F1? Is it Goodyear Tires for obvious reasons? Or is it a company like GM, which is now getting into the sport via Cadillac?
Yeah, that's an interesting question because all of those elements should have a benefit from the popularity. But I think I would want to go back to the source, right? Liberty Media is not just F1. We know they've got Sirius XM, they've got all these other elements to them. But I think that's where the source is. And so that's where I think I would probably look to put money to work if I was going to do an F1 bet. But I also think when you put streaming along with it, you can't beat Netflix for a good investment related to those items either.
And as somewhat related to this, Malone told me that he believes, and who am I to argue with John Malone? I mean, this guy's done everything over the course of 40, 50 years in the media industry, that big tech will dominate the future of media. Now, we're seeing with Amazon and the NFL, but he called out Oracle, which is interesting. But at the end of the day, big tech has all the cash. Legacy media doesn't have all the cash.
Yeah, and look, I listened to that interview and I thought that was the most important point that he made of the entire interview as well. The fact that you have big tech and you have streaming, he believes that there will be some sort of consolidation, at least that's what he said during the interview, but also talking about streaming and that social media is merging with with streaming, and that you have a lot of people that are getting their news, their entertainment through, for example, YouTube, which has been absolutely huge. And then if you couple that with live sports, then you have a sort of blowout combination there. So the fact that what he was talking about was big tech with all these platforms, with all these users that are on social media, that are getting their streaming from there, that are also getting their live sports from there as well. That's pretty explosive when it comes to the entire industry.
Inez, I did a 40-minute interview with the guy. That's the only interesting point you found. I mean, it's like a real blow to my ego. I mean, you're killing me here.
No. His entire story was very impressive, and his father and what his father had worked on and everything. That was impressive, of course. But the future of media is what I'm talking about, where we're going in the future.
Thank you, Inez. I knew you would handle the follow-up question with perfect ease. All right, it's time now for my question of the day. The push to re-engineer old food companies to extract better growth is a playbook that has been run all year long, and today is the latest prime example. About a decade after their much-hyped merger, Kraft Heinz said they would split into public companies, One will focus on shelf-stable meals like mac and cheese. The other one will put attention to Lunchables and packaged cheese. This merger has been really a disaster from the start, leading the stock price to tank about 60% since 2015. I talked to Kraft Heinz CEO Carlos Abrams Rivera. Said the brands, the team just viewed them as undervalued. That's why you're seeing this news. Meanwhile, feared activist investor Elliott Management has taken a $4 billion stake in PepsiCo and will agitate for changes to improving sagging earnings growth. A source familiar with the matter tells me. So my question is this: do you buy old food stocks in the hopes big changes happen? Victoria, over to you here. If you had to choose, do you bet on Kraft Heinz that will be split up after, I believe it's the second half of 2026, or do you go more near term and an Elliott agitating for big changes at PepsiCo?
Yeah, I think if I'm choosing one or the other of those, I'm probably going more towards PepsiCo. But food stocks have just not really done well this year, right? Whether it's Mondelez or Lamb Wesson or Kraft Heinz or whichever one, that whole staples category has suffered a lot. A lot of that is snack foods, and so you have the GLP-1 component that comes into it as well. That is true in PepsiCo also, but the fact that you have Elliott Management coming in now, the fact that Coca-Cola has done pretty well, and so maybe they can make some changes, PepsiCo can make changes to kind of catch up to that, and they have other elements too, along with the energy drinks and things that people are really shifting towards with their consumer taste. I think I would go much more towards a PepsiCo than I would looking at some of these food stocks that right now are just struggling as part of that staple sector.
Brooke, I reviewed the slide deck that Elliott sent in PepsiCo, and it doesn't. They stopped short of saying or going on to that argument that Nelson Peltz brought. I believe it was in 2015 when he attacked PepsiCo. Peltz wanted them to break up the food and beverage business. Elliott is not going that far. They outlined a lot of changes that PepsiCo, if they're receptive and they actually listen to them, they could do, and that could unlock value. I don't know if it's going to unlock 50% upside like Elliott says, but still, changes could be made.
Yeah, and investors are optimistic about the fact that these changes can be made. You see the stock rallying up more than 3%, nearly 4% intraday. After year to date, it's only been about up 2% as the company's been under pressure because of some of the aspects that Elliott Management had called out, like weakness in their food business here in North America. Of course, PepsiCo had bought out Siete Foods. They also put that major price tag on buying the probiotic soda brand Poppy earlier this year, and it's often dismissed or often not remembered, among Main Street that PepsiCo is behind Frito-Lay and also those other major, Pepsi brands that really have become notable of what they're known for. But also, it's worth noting that the Elliott Management also shouted out the fact that they said that what they want here is the company to ultimately reiterate and return to a strong execution. They ultimately want the company to re-accelerate growth, enhance margins, and these are all businesses that have been under pressure as consumers have been, not as willing to jump into the CPG brands like they were post-COVID, when that led to the peak that we saw in 2022. And since we've seen that downfall, but the company, or rather the hedge fund, ultimately calling this a rare opportunity for re-acceleration of a really well-known company. And
PepsiCo did not return my request for comment on this one. A big thank you to my roundtable for today: Victoria Fernandez, Brooke De Palma, and Inez Ferre. All right, for my forward-looking thought of the day: breaking up a legacy company isn't easy. Management has to think through all sorts of issues, from tax considerations to where the headquarters will be, to which employees will go with what division and why. In the process of the breakup, it could lead to massive distractions internally and weigh on performance in the process. Proceed with caution in putting money to work on companies in the middle of a breakup. Just like in life, a breakup could be really messy. Straight ahead, Julie Hyman has you covered from Market Catalyst. Don't go anywhere.